Thank you all for coming, everybody online and in person. Welcome to YPN's tax seminar for the year. I'd like to introduce Carolyn and Aimee from Carolyn Associates. They will answer all your questions, not only for you guys as agents, but also a wealth of knowledge for your clients as well. Feel free to put any questions in the chat, and for everybody here, there's a happy hour afterwards, and if anybody online wants to come as well, we'll be at Anina afterwards in Hidden Valley. So without further ado, Carolyn, take over.
All right, I'm Carolyn Cotter. I'm a CPA and I've been doing taxes for 16 years now, with a high concentration of clients that are doing what it is that you do in real estate. So each year we come here and talk about the issues that are relevant for you and kind of what you do as an individual or an entity, which I will use that to segue into the first topic, which is, should you be an entity, your own separate entity, or remain a sole proprietor individual? And that's largely going to depend on what sort of legal protections you want to make sure are in place, which is beyond the scope of this conversation. But from a tax perspective, the real defining factor is going to be the net income that you are estimating or that you have earned in a prior year. Obviously, things can be quite volatile, and so there may not be as much consistency, and you may not know what it is that you're going to net until you're into the year, which can be challenging because we encourage you to make the decision about whether to create an entity or not, either in Q4 to make it as of 1/1 the following year, or Q1 to make a retroactive as of 1/1 in the current year. So what is the benefit, I guess, what are the pros and cons of creating an entity? Aside from like I said, the legal protections and the branding, it can save you on taxes because as a sole proprietor, you are paying not only ordinary income tax, but also self-employment tax on everything that you are netting. So if you were a W-2 employee, you would have taxes withheld, both income tax and payroll tax, and your employer would pay a portion of payroll tax as well. When you're a sole proprietor, you're paying both the employee and the employer portion of payroll tax. So that adds up to about 15%. And that is on top of the ordinary income tax that you're paying on all of your ordinary income. So what makes having something like an S Corp different is that from the S Corp net earnings, you can pay yourself an income. And so there will be payroll taxes assessed on that as a W-2 employee. But the remainder, once you've paid yourself a reasonable salary, can be taken as a distribution. And while that's subject to ordinary income tax, it's not subject to that 15% self-employment tax. So this really starts to make sense. And when I talk about the cons, you'll understand. But it starts to make sense around $100,000 that you're netting. Again, you would want to have some consistency there. If you were way below 1 year and way above the next year, kind of waiting until you're consistently at or above 100,000 is when you would want to make that determination and likely convert to an S corporation. So the cons of it are that it is a separate entity, which means you have to register with the Secretary of State. You have to pay at minimum an $800 annual fee for the privilege of doing business in California. And then you have to file a separate tax return, which has a balance sheet on it and an income statement on it and some other informational disclosures. So that requires a bit more from an administrative perspective in terms of maintaining really clean separate books, which I'll get into a little bit later. You'll want to do even as a sole proprietor. But it's also, that filing fee and the $800 minimum tax that you're paying. And depending on how much your gross receipts are as they climb, it could increase from the 800. So I will pause there to see if there are any questions live or in the chat on entity formation. Okay. Yes,
What about the difference between doing an LLC as opposed to an S corp with the additional tax fees that arrive based on gross income? Maybe you should, because I know a lot of people get advised to become an LLC instead of an S corp.
Sure. So an LLC, if you are the sole member of the LLC, all of the income still shows up on your federal income tax return, your individual income tax return on something called a Schedule C. So it resembles a sole prop from that perspective, but it is treated as a separate entity for California purposes. And there are LLC fees that you incur based on your gross receipts that are sourced to California, which in your case is likely to be all of your gross receipts. So there are brackets. As I mentioned, the $800 is the minimum that applies to both S corps and to LLCs, but it climbs from there if you are an LLC based on your gross receipts. So if you're bringing in a lot but not netting a lot, you may end up paying tax on that gross revenue, even though you have a small net income. So as a single member LLC, there isn't the separate tax return filing. There's a form called a Form 568 that you do have to include with your Form 1040, which is for the LLC. But with an S corp, it's truly a completely separate filing. None of it is attached to your 1040. It's its own entity with its own EIN and its own filing. So there's the preparation fees. Whereas with the LLC, you could incur additional LLC fees as your revenue rises, regardless of how that impacts your net income. Okay. All right. So even if you remain a sole prop, or if you convert to an S corp or an LLC, it's really important to maintain a separate bank account, because if you are charging your expenses through a personal bank account or personal credit card, even if you're meticulous with your records, if you were to get audited, there's a lot more work that goes into untangling the two and proving what is business versus what is not. So if you open up a separate bank account and have a separate credit card and only business related expenses go through that, then it's a lot easier, not just for you because it's all in one place and you're not having to go through and carve out what's business and not, but also if you were to get audited, much cleaner. So that can be really helpful. I also would recommend having some sort of bookkeeping, books and records maintained. So many will wait until January, February, March, maybe even April, and start to get organized with, even if they have a separate bank account, start to get organized with categorizing all of their expenses. It is a lot easier to do that in real time as you go along. So there are a few options that are pretty low cost. You could do QuickBooks, you can do Xero, you can do Wave, which is a new one. All of them are very low cost, and you can actually link your business bank account to QuickBooks so that all of your transactions are flowing in real time. And there is a new AI functionality, and it's quite smart, and it learns a lot as it goes along. So it will start to categorize your transactions automatically. And then as you go in and verify those, it learns, it makes rules. So it knows every time you have a transaction from this vendor, it's staging or photography or something like that. And so then it really does the work for you. You link it to the bank account, all the expenses get categorized. You're just going in there periodically to verify those. And then at year end, you're in good shape. So I believe there may be, and I don't know if you can speak to this, Alex, but there may be a software that you guys have some sort of discount on in terms of tracking expenses or books it. No, okay. So in addition to maintaining separate books and records with transactions flowing in from your bank account, you also want to track things like mileage. And that's not something that you can track within a bank account, right? So there are apps such as Mile IQ, where you can have it track. You just indicate when you are starting your trip and when you're stopping it, and it's going to add up all of your mileage for you. And that is really, really helpful. You do not want to have to estimate that come year end. that's risky, and it tends to be quite inaccurate, and you end up underestimating, and so you're not maximizing your deduction. So other software versus QuickBooks. Okay, so is the question I can speak to, so Xero and QuickBooks are very similar. Xero came on the market after QuickBooks. It's based out of Australia, so it was really popular in Australia and UK, and then eventually kind of started gaining some market share in the US. They are very comparable. Either one is great. Didn't earn anything from being a real estate agent last year, but paid all the fees. Are these deductible? Not an LLC. So, yeah, they are deductible. If you are, truly in pursuit of eventually a profitable trade or business, and you are actually conducting that business activity. So it's not like you have an idea and you just start like incurring costs around legal or, testing the market or getting educated, doing research. Those would be more so startup costs. But if you're truly out there pounding the pavement, or whatever the comparable phrase would be for this current kind of remote world, that you can deduct those costs even if you have not landed a sale and don't have commissions. There is, the more time you go on not bringing in any revenue. So let's say you went 3 years with no revenue and only expenses. There is a risk that the IRS could say that this is a hobby. It is not quite a common hobby for someone to get into real estate. So, you'll more often see that with, for example, if someone is like, I'm really into embroidery, so I'm going to start my own embroidery business on Etsy. And then there's year after year of only expenses and no revenue. That would be a little bit hard to argue that it's anything beyond just a hobby. You like embroidery, you like doing, arts and crafts. But with real estate, it's a bit different. So yes, you can deduct that. And it is okay that you are not an LLC. Does Xero handle payroll and taxes on the payroll? So for payroll, you will have to set that up separately. The two that I'm most familiar with, I think Aini can probably speak to ADP. She has a lot of experience with them. I have some experience with Gusto. Either one are great, but you will need to have a separate payroll processor.
I can speak to ADP. We have a dedicated ADP person who we have been using for close to 20 years, which is a little uncommon in the payroll business because it tends to be a transient position. Mm-hmm. Our person has built up enough of a book of business that this is a good career for her. Mm-hmm. And we are happy to turn anybody on to her. ADP, I believe, does tend to be slightly more expensive, but it is very comprehensive and they handle everything, and there's somebody to talk to every time you have a problem. And you talk to the same person, which really in the end, when you have a problem, you want to be talking to the same person. Mm-hmm. So, I really advocate for ADP because of our relationship and, mm-hmm. and the problem issues which come up. And when they do, it's awful. Mm-hmm. I wanted to step back though and also throw in that in terms of bookkeeping, Excel works perfectly fine as well. And I think visually, Excel, if you're not a bookkeeper who is familiar with maintaining a balance sheet, which becomes important with an S Corp, an Excel sheet is going to give you more of a visual. And of course, when you turn it over to us, then we can pick out the things that will adjust to a balance sheet. And it would start simple. You would have your beginning balance and what's gone in and out, and you spread it across to expense types. It's simple. I kind of like it rather than some of these other more complicated programs where somebody might have made a mess. Mm-hmm. So I'm just throwing that out there.
Yeah. And you will, as your business grows, you will likely outgrow QuickBooks at some point, even if that's, or Xero, even if that's the route that you do go. And so there are bookkeeping services where, someone is going in at whatever cadence, makes sense. That could be monthly, it could be quarterly, it could be annually. And, kind of cleaning things up for you, booking the appropriate adjustments. If you have, things like fixed assets or even intangible assets, there are calculations that have to be done and recorded as adjusting entries. It is a lot easier to keep track of what you've contributed in versus what you've distributed, because then you start to get into, at risk and basis. So there will definitely be a time where you outgrow that. And even before that, if you want help and you really don't like the idea of having to manage anything around your numbers, we are here to help.
So we have a team of very experienced bookkeepers. They've been in the business for 20, 30 years, working with us. And I would say that the time to switch to an accounting firm is when you're prepared to pay a minimum of $500 a month for this. That would sort of be your gauge.
Yeah. And once you start to have, if you start to have multiple people on payroll, that's usually a pretty good indicator that you want in an accounting firm. So going back to ADP and Gusto, so one thing that ADP has that Gusto does not, at least as far as I know, is that ADP can make us the accountants on your ADP account so that we can go in and pull all the reporting that we need, whether it's for the ongoing bookkeeping or if it's to verify what's in QuickBooks to ensure it's properly reported on your tax return. You can also do the same in QuickBooks or Xero. You can make us your accountant. So we essentially can go in and pull the reporting so you don't have to pull it for us. And if there's anything that you're unsure about where it should be recorded, you can report it to Ask My Accountant expense account. And then we can go in and take a look at it and make sure it's recorded to the proper place. We can make adjustments as needed, make sure everything ties out to the tax return. So it's really helpful when we have the My Accountant access.
Okay, we get 20% discount for ADP payroll by our bank. You may want to ask your bank business manager if you have a business checking account. Awesome.
And if you haven't opened up a business checking account, maybe if you could share in the chat what your bank is, then maybe it would make sense for individuals to open up a bank account there so that you can get the 20% off ADP. Alex?
Want to add in terms of a couple steps back, but in terms of expense tracking.
Yes.
There are plenty of US credit cards that if you just run all of your business expenses through that one credit card, at the end of the year, you download it into Excel, and it's merely a question of taking the time to sort through it all and turning it in that way. That, in my experience, has been the easiest way of tracking rather than using a single credit card for both personal and business, and then having to sort it as a whole that way. It's also, plus side is you also get more points. But
that helps.
But in credit card,
Yeah.
Not a bad thing.
Yeah, absolutely true.
Okay. Car loan interest, is that deductible? It is new.
So that is deductible. However, only to the extent of business use of your vehicle. So one of the important reasons to track mileage, there are two ways to calculate the mileage deduction. One is you just take the amount of business miles you drove and multiply that by the standard rate, which is provided by the IRS each year. I should know what it is for this year. I do not. But let's say it's 70 cents. So every mile you drive related to business, you multiply it by 70%. That is one way to calculate your deduction. Another way is to look at all of the expenses you incurred related to your vehicle and multiply that by the percentage of business miles over total miles you drove that year. So basically the business percentage, let's say that's 60%, then all of your vehicle expenses in terms of gas, maintenance, insurance, your car payment, all of that good stuff, then goes into kind of the base. And then we multiply that business use percentage in my example, 60%, and you get to that, that calculation. And then whichever is greatest is what you would end up deducting. So. But
Another option here for people who are doing very well is to have two cars, one which is devoted to business, and then you don't have to track anything.
True?
Or, and then have another one for personal use.
Yes. Yeah, and in that case, the kind of safe harbor for that is you are using the vehicle 95% or more. So if you use it 5% for personal, they'll give you that as part of the safe harbor, but yeah, so that is definitely an option. Thank you. 70 cents, 72.5 cents in 2026. Great. Okay, so kind of along those lines, business use of home. So pre-COVID, many people were working from an office, even if you were going out to meet with clients, to listings, open houses, all of that. Now it's more common for there to be more time spent working from home, or at least some hybrid approach. If you do make your home office your primary place of business, then you can deduct a portion of your home expenses as the home office deduction. So kind of similar to how we calculated the vehicle, you would, there's two ways to calculate it. One is to take the square footage of your home office. So that's the space in your home that is dedicated to office space that you use to conduct business. Multiply that by a flat rate and you get your, deduction for business use of home. Tends to be more lucrative or give you a greater deduction if you use the other calculation, which is to take all of your expenses related to your home. So that could be rent, utilities, insurance, maintenance if you own, HOA fees,
Mortgage interest.
Taxes, and that total gets multiplied by the square footage of your home office over your total square footage. So again, if you think of it as like the business use percent of your home, you multiply that by your home expenses, and that gets you your home office deduction. So one thing to note about that is if you are in a loss, so the revenue you generated is lower than the expenses you incurred before you take into account your home office deduction, you cannot get a benefit of the home office deduction. It can't make your loss greater, but it does carry over. So it's still worth claiming it, even if you're in a loss, because then it can be carried over and used in a year where you have net income. Does anyone have tax preparer recommendation? So I'm a tax preparer. And so we are accepting new clients, have a high concentration of individuals and small businesses that are within the real estate industry. So I would say we definitely have an expertise there. Our rates are very reasonable. And we really work to develop a advisory type relationship. So we don't want you to be afraid to give us a call if you have a tax question. So the flat rate that we charge on your return to prepare and file your return, if you've got questions, quick questions that you want to call us about or email us about, we're not going to charge you extra for that. If there's additional work that goes into it, like modeling out your taxes or really doing additional research or analysis, we could then scope out what that would cost at an hourly rate, but we would, disclose that to you before embarking on that. So it really is intended for you to feel like you can come to us about, any questions that you have around tax. Many clients also come to us looking for, financial advice, and then we've got to steer them in a different direction, or legal advice, and we've got to refer them to an attorney that we have a relationship with, but we can always be your kind of first point of contact.
I think I'd like to put in here that if somebody does call us or text us or email us, you need to tell us how you heard of us. We are being bombarded. The entire accounting tax industry is being bombarded by people who are trying to get into our systems and gather information. So we do not talk to anybody unless you come with a referral.
I am shocked by how creative these scams are. It's wild. I consider myself like pretty sharp when it comes to this sort of stuff, and they will reach out. They will give you like the specifics of their tax profile. They'll say they were referred by someone and they'll give us a random name. So we now have to make sure we actually have someone like that in our contacts or have done work for them before. So being specific, talking specifically about this session is very helpful. And just try not to attach anything in your emails, because often scammers will say, I've attached my prior year tax return, because they want you to open it up and then, you know, typical phishing. So
Yeah, I've had somebody who said, oh, it was great talking to you. And I'm going, I don't remember.
Right. Yeah, it's wild out there.
Can a real estate commission be paid directly to my LLC if I'm a licensed as a salesperson and not a broker? If commissions must be paid to me individually first, what is the proper way to transfer those funds into my LLC account while staying compliant? Is transferring the full commission into the LLC acceptable for accounting and separation of business funds? So I can't speak to salesperson versus broker. I'm not entirely sure how commissions are handled in that regard. But regardless, if you transferred it into your LLC account, absolutely. The best way that you can do it is if there's a way for you to indicate in the memo what it is for when you're transferring it. And the best way to do that is to put the address of where the commission's coming from, the property. So if you do that when you're making the transfer, it's a lot easier to track. And the other thing is you're probably going to get some sort of 1099. And so that 1099 substantiates that the revenue is earned from the business.
The commission check should go straight from title to the brokerage account,
Mhm.
and then the brokerage account to the LLC account.
Okay.
And from LLC to, your personal account.
Right, okay.
That's how it should track.
Yeah, so if it is transferred into the LLC account and then you need it to cover expenses or whatever, you can do that. It'll just be treated as a distribution. If you have a separate LLC, it'll be treated as like a distribution from your LLC.
So hopefully that answered that question. So some other
Questions that come up tend to be around what expenses are deductible. So, the most common expenses that we see is going to be, fees, whether that's like MLS fees or membership fees. You would also, perhaps be attending conferences, local conferences, or if you're trying to expand into a new market, that would be deductible. Any sort of marketing materials, of course. So that's business cards, that's mailers, that's if you're advertising online, if you're paying for photography, staging, if you are going to out to eat or coffee with a client, that is deductible up to 50%. So not fully deductible. If you are taking your client to a Warriors game, that is entertainment, that is not deductible, unfortunately. But meals are, as long as business was discussed. Doesn't have to be discussed for the entirety of the meal, but it does have to be discussed. And then, like I said, the 50%. And any travel, if you're doing any sort of travel where you are grabbing a meal while you're, on the road, and it's, accommodating your ability to travel, that would be deductible as well. If you're just working from home and you order takeout, that would not be, because that's, something you would incur regardless.
It has to be a restaurant. So you can't deduct things from a grocery store.
Okay. Yep, that makes
That's
sense.
my understanding of it.
Okay, that makes sense, yes. And it used to be during COVID times, you could deduct 100% if it was at a restaurant because they wanted to incentivize people eating out at restaurants. They have now brought that back down to earth at 50%. So you can, to a very small extent, deduct gifts for your client. So it is limited to $25 per client per year, which has not been adjusted for inflation as long as I've been doing taxes. So obviously that does not get you much. So one creative way that actually came out of one of these talks is you can cover the warranty for your client as a gift, and that is fully deductible.
Mhm.
So get creative.
Some people have been throwing around cost segregation this year more than ever before.
Interesting. Okay.
Can you talk about how it's relevant for real estate professionals, whether you're an S corp or individual?
Sure. So cost segregation is it's basically you're taking a piece of property, typically real estate, that is depreciable anywhere from, 27 to 40 years. And you're carving out pieces of that into asset categories that you can depreciate over a shorter life. So it's not changing the amount that's deductible over the life of the asset, it's accelerating it so that you can deduct it over a shorter period of years. So that would only apply if you actually have property that you are depreciating.
Or an airplane.
Or an airplane, sure.
So it doesn't sound like it has much relevance in the real estate world.
It doesn't. If you're in commercial real estate, perhaps if you're hearing about that from a client who is looking to do a cost seg on a property that they purchased, that makes a lot of sense. But in terms of for you that I can't think of any.
And cost segregation is not an inexpensive process, because each asset that you divide up into little parts becomes a project. You have to have the value determined. So if you decide to segregate your HVAC system from your building, you need to figure out what is the value here so you can depreciate at different rates.
So it's extremely common in large, like hotels, for example, or if you own a manufacturing plant, if you have, a winery, things like that.
Or a huge piece of equipment like an airplane.
Right. What about properties that I own personally and want to sell and self-representation? Can I transfer those properties to an S corp and deduct through the S corp? So you have to have a separate entity, because that is a completely separate business activity. So if you're talking about property that you own and you want to deduct the expenses, like the expenses of maintaining it or associated with renting it out, we definitely do see a lot of overlap. Many, agents will also have property that they rent out. Those are two different business activities, despite the fact that they both involve real estate. Those should not be commingled in a single entity. That will only hurt you, because if you have rental property, there are certain rules that or criteria, I guess, that you have to meet in order for that to be deductible if you have a loss. It's the passive activity loss limitations. So that's just a totally separate beast that I won't go into, but just know that if you have a business, a separate business, such as rental property, that should go in a separate entity.
It's almost like filing a return saying you're a hairdresser and a dog walker. They're not the same thing.
We do a lot of rental property. Yes, a lot. Whether that is through an entity or if you just hold it as an individual and we report the rental activity on something called the Schedule E, which is part of your Form 1040. We do a lot of that. Okay. Can you at what point does it make financial sense to move from a sole prop to an LLC? So if you were to move from a sole prop to an S corporation, it makes sense around the $100,000 net income mark. From a sole proprietor to an LLC, because it doesn't give you that same tax benefit of reducing your payroll or self-employment tax on your earnings, but it still has the registration costs with the Secretary of State. It still has, a separate filing, the Form 568 attached to your 1040, and it's still, you still have the potential to have even higher LLC fees if your gross receipts are high. It's probably not super beneficial to convert to an LLC in this line of business, unless there is something where you're concerned about having a legal separation.
But an LLC, while it's called a limited liability company, that is somewhat misleading because there are limits to that limit on your liability. So,
I think it mostly applies to partners or other members, the
Right.
liability. So if you have somebody injure themselves on your property, it's not going to cover you for that.
Mhm.
For that, you get insurance.
can you deduct theater tickets if you gift them to your client or take them to the theater? So it would be, the theater tickets would be $25 per person per year. So let's say you gifted tickets and it was intended for a husband and wife that are your clients. You could do 25 each, so 50 total. If you were to take them, that would be not deductible at all, because that's considered entertainment, client entertainment, and that is not deductible. Best way to hold rental property for taxes, trust, LLC, etc. So Amy is the expert in this realm, not me. So I will defer to her.
Okay, well, I generally don't like LLCs to begin with. So I would, most of my big, property owners file they maintain the ownership of their property independently and look to outside insurance to cover any liabilities there.
So they hold it through an S corp, a C corp, a trust.
They just hold it individually, so it's a Schedule E on your personal return. Now, that's most of them. You certainly would never want to own property in a C corp.
Yes.
You would be subject to double taxation.
Yes,
It's
a
really a
nightmare.
problem.
Yeah.
So, it really would depend on the other information on the client. It's a little difficult when somebody calls and gives you just a little piece of information, when in fact, there's a bigger picture to take into account. So that's a hard question to answer and really done more on an individual level.
And we can only advise on the tax implications. There are always going to be legal implications. And so before creating any entity, you would have to advise with an attorney. I will just clarify. So for a trust would make sense if you were concerned about what happens to the property upon your death. If that is not your concern, it does not make sense to put it into a trust. A trust is not for the purpose of tax savings. It's really for the after death, to ensure that it's simpler to execute your will, to avoid probate, all of that good stuff.
Yeah, that would be part of more of an estate planning
Yeah.
issue, which would be another area of expertise.
Just a general question. My husband and I have been looking for years, probably futilely, for a role that is kind of a hybrid between a CPA and someone who knows the IRS code inside and out and can look for creative ways to avoid paying taxes, not evasion, but creative ways to avoid. Is there such a role like that?
Yeah, so I mean, I would consider myself that. I'm a CPA. I also have a master's in tax, which means that I got my master's in the tax code, essentially. However, there are very limited ways to get creative with the tax code. It's been around for a long time. There are pieces of tax reform. The biggest one recently was last year, and then before that, it was 2017. But before that, it was 1986. It doesn't change often. And so if you identify something, someone has already found that, exploited it, and the loophole has been closed. So there are ways where, I can advise you on things that you can do to minimize your taxes. Or if you are choosing between, one thing or another, buying versus leasing, if you are trying to determine whether to donate this year or pay your property taxes early or wait until next year, like those sorts of things I can certainly advise on. And in terms of, entity structuring, whether to hire someone on as an employee or an independent contractor, like all of those questions I can answer. But there's only so many ways to get creative.
I think a lot of that comes up as we're doing the tax return. If we see something then we will, advise you on, well, how about if you do it this way or that way, or, you know, we look at it a different way. So that happens automatically in our process. And sometimes we have clients who come to us and say, well, what if I did this? Then we'll research it and find out, well, does this work? Does it not work? How do we make it work? But to go to somebody with, you know, just a blanket, the tax code is huge. So a lot of this would take some investigation and reading it with perspective.
I think one of the benefits of working with a CPA or, you know, a CPA firm like us is that because we have so much experience with realtors, like if you send me your list of expenses and there are things that I typically see that I'm not seeing, I'm going to reach out to you and say, what about this? What about this? What about this? Or, you know, like little things, like sometimes 1099s can be reported at gross, or they can be reported net of what your brokerage took out. Like just knowing those things to ask, those questions to ask. And also with, you know, being of a similar age, being a millennial, I kind of have a similar outlook in trying to, I want to educate you in addition to just preparing your taxes and filing your tax return. Like I want to educate you so you feel like you know what's going on. And I think that's something pretty unique.
I think where you would go outside would be for estate planning, longer term financial planning, insurance. You know, all of these are like being a brain doctor or a podiatrist.
Specialist.
So, you know, our area of expertise is in the tax area. But, you know, and certainly legal, you have to go out. It's
Yeah.
not something we can address.
But we can certainly, so, you know, there are many individual clients where we will be working with their financial advisor. So something like a backdoor, you know, Roth IRA, that's sort of like, it's a retirement vehicle driven by, you know, the tax benefits, but it has to be carried out by like the conversion of a contribution to an IRA to convert it to a Roth, backdoor Roth, has to happen, you know, through some sort of brokerage. So investment brokerage.
I'd like to add also that we are associated with 2 tax attorneys that we work with regularly.
Yeah.
One of them will do a lot of the businesses that would be local, and we have one that deals with our international clients. So we have access to this, and we will regularly say, you know, advise people or give you directions to look if there's something out of our scope.
Mm-hmm. Yeah, absolutely. And we're referring you to people who, you know, have a similar approach, similar demeanor, bedside manner, for lack of a better descriptor.
Not to mention a 20-year relationship.
I was going to say, and we're vouching for them, right?
Yeah,
So
absolutely.
in San Francisco. So where are we located? In full transparency, I live in Austin. I lived in San Francisco for 10 years, which is when I began working with INE. I, during the pandemic, moved to Austin, but I am back here regularly. And I would say 90% of my clients are in the San Francisco Bay Area.
And so I've lived in San Francisco since 1969. I moved here when I was 17 in a fabulous year. And many of my clients are foreign. So I have clients in Sweden, England, Singapore, China, now Turkey. I just got a new client in Turkey, so Germany.
Yeah.
So and after COVID, I did get a small office. I used to have a big fancy office, but now it's a small office. It's really, nobody comes there. And you don't see clients too much anymore. Sometimes you might meet them for a glass of wine, if you're really close, dinner. But in terms of having somebody come sit at your desk, that I don't think that's happened since COVID for me.
Mm-hmm.
And you don't see clients at No,
No, I mean, I will
Yeah.
have, so the question was, how long is the waiting time to schedule an appointment? So there isn't a waiting time to schedule an appointment. What we generally like to do is if you send us an email with a little bit of information about what you're looking for, what your tax profile is, you know, whether you're W-2, 1099, kind of if you have a partner, if you have a child, if you own, all that sort of stuff. And then I will schedule an introductory call with you just to learn a little bit more about you, explain what it is that we do, and kind of talk next steps, timeline. And yeah, I mean, we're taking on new clients. Once we get past March 15th, if you're reaching out to us, we are gonna, well, assuming it's before April 15th, we are going to file an extension for you. It's just not realistic with the backlog that we have that we're able to get through, you know, full filing for all the clients. So, but if you believe that you're going to be owing money, we can, you know, hopefully do a quick and dirty calculation so that you can pay in with your extension and you're not incurring late payment penalties and interest. And then once 4/15 is over and we've taken a breath, we can then revisit and file your return.
and again, you need to, when you connect with us, let us know how you heard of us.
Yeah.
Where you got your referral, otherwise we will ignore your email.
Yeah. Well, sometimes I like to play some games.
I do occasionally
Yeah,
too.
yeah. Can you extend more about the penalties? Yeah, great question. Actually, let me go up to, okay, I think the last question was, how is AI affecting you? So interestingly, AI is, you know, only, I would say, enhancing what we already do. So I mentioned, you know, in QuickBooks, there's AI functionality that will start to learn how to categorize the transactions that are coming in. In the tax software, AI will, you can opt into some analytics that will tell you potential opportunities that you can take advantage of that you haven't, and it will actually quantify for you what those savings would be. So if this person were to contribute to a SEP IRA, which is basically an IRA for a self-employed person, you know, they'd be able to contribute $20,000 and they would save $7,000 in taxes, something like that.
This capacity is already in our,
Yes.
in the software that we use.
Yes.
We use the
Yeah.
best software.
So that way, like, all of this stuff can be obvious to us, but it really, I'm not able to do that math in my head. So having like the analytics there to, you know, give really like a bullet point of like, here's some things that, you know, they could be doing to save some taxes, and not all of them will make sense. But so it's really just enhancing what we already do, I would say.
And making the research function easier.
Yes. And eventually absolutely true. Yes. One thing that I think is making it more challenging for us is that with a ChatGPT, for example, many clients will do the research on their own and then come to us to verify it. I would rather you just come to me with the question, because I don't like to have to explain why ChatGPT is incorrect and then tell you what the accurate answer is. Just come to me and I'll give you the accurate answer. I understand wanting to like take a first stab at it. It does end up creating more work for us though.
At which point we would have to charge.
Yeah, so it's just come to us, and yeah. But I appreciate people wanting to leverage the Buzzy tools. If my husband has an S corp and I do too, is it better to do taxes together or as separate individuals? So the fact that you both have S corps actually does not weigh into that decision about whether to file separate or married filing joint. I think, yeah, taxes together or separate. So if you are married and living together, you have to file either married filing joint or married filing separately. 9 times out of 10, you're better off filing married filing joint. There are some exceptions. One wrinkle that was introduced at the end of last year was the increase in the tax deduction on your Schedule A. If you itemize deductions, it used to be that you're limited to $10,000 of taxes, of a tax deduction, which is obviously nothing in California.
That's property taxes, sales taxes, and income taxes. That has expanded to $40,000. But you can actually, if you're filing separately, you could potentially max out the $40,000 separately, whereas if you're filing jointly, you're limited to $40,000 altogether. So think of it as like per return. So there will need to probably be more analysis, which we can do. Our software actually allows you to input everything, and then it will do the analysis to figure out if you were filing separately, what would be the impact. So we are happy to do that. In terms of, we get a lot of questions about, we're engaged, when should we get married? Or what are the tax implications of us getting married? So Aini likes to say this should have nothing to do with taxes, but I understand the sentiment. So taxes are the way our tax system works is interesting in that it was, you know, there's something called the marriage penalty. Essentially, back when households had primarily one provider, one breadwinner, when you got married and you filed jointly, it was actually beneficial because you had one person's income spread across two people's worth of tax brackets, for lack of a better descriptor, and two people's worth of standard deductions and credits and things like that. Now that most households have dual earners, it actually ends up being a penalty in many cases because it pushes you into that higher tax bracket and oftentimes can phase you out of certain credits or deductions. Filing separately, however, does not solve that problem. You still have the same, tax brackets. You still have the same phasing out. Really, the only time that it makes sense is I had a client last year who wanted to show only her income so that when she went to apply for or restructure how much she was going to be repaying on her student loans, it wasn't commingling with her spouse's income. I've also had clients where they're separated but not divorced, and they really want to keep things as separate as possible. But yeah, aside from that, it really makes sense to do filing separately. We'll see how it pans out with this new increase of the tax deduction on your Schedule A, a few itemized deductions. But again, we'd be happy to run that analysis for you. What if you are behind on filing for 4 years and have an LLC before starting real estate? Any advice?
We get a lot of those.
Yeah, I guess it depends on what you mean by behind on filing. If you're behind on filing your taxes for an LLC, eventually your license to do business in the state of California will be suspended if you don't stay up with the FTB filings, the Franchise Tax Board filings. So we would then need to file your returns. Because it's an LLC, you would owe a minimum of the $800, and then late filing and late payment interest and penalties would increase would be calculated on that. So you would end up paying, more. And then once those were filed, you could then file to have your license to practice business reinstated. This has nothing to do with your license as a realtor. It's just the entity. So I would say my advice would be.
And at that point, you'd also have to refile or amend your personal returns if you've already filed those. Yes.
Unless it were just a loss flowing through and we could but still, it's still gonna, that's correct. But I would say it feels daunting, but the longer you wait, the more painful it is, I promise. But this happens, I don't want to say all the time, but it's not super unusual. So don't be afraid to reach out to us and we can help. Open house goodies, water bottle, candies, nuts. Yes, those are deductible. We work with, are you basically for realtors or do you work with property owners? Also across the board. I mean, every industry, every type of business. It just happens to be that we get a lot of referrals from our existing clients. So because we had a lot of realtors to start with, We then got referrals from more realtors. And so we have a concentration of it, but I mean, we've got hundreds of clients, right? And it runs the gamut. Since social media and video is now a big part of our marketing, is there a way to write off any additional look services such as haircuts, facials, clothing? Okay. I know there's a lot of information out there. There's a lot of like influencers who like to talk about like how to make your dog like security and be able to write off their pet insurance or their pet bills or vet bills. So I know there's a lot of noise around this, but this is not deductible. I understand, you want to obviously look good. If you were wearing clothing that it was not suitable for everyday use,
A uniform.
There's even some gray area now around if you're like a litigator and you have to be kind of dressed to the nines when you go into court and you otherwise have no use for that. But like for, real estate, the answer is no, unfortunately. And there was a question, sorry, I want to go back to it around, can you expand on penalties and interest? So I definitely want to go back to this because, when you're a W-2 employee, you have taxes withheld out of every paycheck and remitted to the IRS and the state taxing authority in California, that's the FTB. So if you are not having taxes withheld, the IRS says, out of fairness, you still have to prepay. And you do so through quarterly estimated tax payments. So what can be challenging about that is with a fluctuation in your income year to year and you not really knowing where you're going to land until the end of the year, it can be hard to know what you should be paying in. There is a calculation method called the safe harbor method. And basically it says if you pay in 110% of the tax you were assessed last year, regardless of where you land, you'll be in the clear. So if you end up making way more than that, like, of course, you're still going to have to pay the tax due on that additional income, but you're not going to be penalized with interest and penalties. So that's typically how we like to do things. If there is, there are many clients who will say, I want to know exactly what I need to be setting aside so I don't spend it. And when I have to pay in with my tax return, if it's more than my estimated tax payments. And so we can run a calculation for something like that. And that's completely fine as well. So you just need to understand that if this is your first year that you owe tax or your first year as a sole prop, there is a 1 year kind of grace period that the IRS and FTB give you. And so if you didn't owe any tax last year, either because you were in a loss or you were a W-2 employee at that time and you had enough withheld, and you don't pay in the current year, then you won't be assessed penalties. But any tax year thereafter, you are expected to prepay. It's like, okay, you maybe weren't sure in that first year, but now you know, so start paying.
And of course, there is the thought of, I've just gotten a big commission, I'm going to go out and buy a big car or a motorcycle or go on a vacation and not save any of your money for taxes. We've seen quite a bit of this and it hurts later on. So sticking to your prepayments at the 110% is really, really, really a good idea. I've seen penalties just escalate and it hurts.
And if you don't want to prepay estimates, like just set some money aside.
Mhm.
If you think about what the tax rate is, assuming, there were no other sources of income, which you do, of course, have to factor in as well as your deductions, but it's generally around 40% for federal and, 8 to 10% for California. So I know that sucks. But put aside that 50%. And maybe you'll be pleasantly surprised and you won't have to pay in as much. And again, if you want to be really precise because you really need that cash and you don't want to set aside any more than you need to, we're happy to run, model that out for you. We owned a condo in SF and rented out before my CPA used to accelerate deduction for our federal tax return. We own real estate in Texas, for example, where we don't have a real estate license.
can we still use the deduction methods while we live in California? So I'm guessing the accelerated deduction you're referring to is accelerated depreciation. So if you own a property, you get to depreciate its value. That's a non-cash deduction because there's no cash involved. There's the value of your property, it depreciates over time. You can accelerate that under something called Section 179 depreciation deduction, which allows you to expense up to 100% of the value in the year you place it into service. So I'm guessing that is what you are referring to. That applies no matter what state you are in. In Texas, there is no personal income tax, which means, it doesn't really make a difference for your taxes, but it certainly makes a difference for your federal taxes.
And in some cases, you would have to, if you had real estate in other states, you may have to file a return in another state.
Almost, if you have physical property, like a physical rental property in another state, you almost certainly have to file in that state, even if you're just claiming losses on it, because
The
you're going to
losses
be
come through.
paying losses. Right, losses can be carried over, and if you do eventually generate income, you want the losses to offset the income in that state on that state tax return. But also, you're filing and paying property taxes. Super, super easy way for them to figure out who's not filing that should be is to cross-reference a lot of the taxing agencies' database and information. That's why if you were to purchase something and had a declaration with customs, but didn't then pay the use tax on it, they'll probably come after you. Any other questions? And you don't have to have a license doesn't matter if you have a real estate license in Texas, you would still file in Texas because that's where the property is, and you don't need a license to own property and rent out there. We also have many clients who rent here in San Francisco and then have purchased rental properties in other countries like Colombia, Portugal.
Yeah. Argentina.
That seems to be a popular
New
strategy.
Zealand is the new one.
Yes, New Zealand.
There's also, it can get complicated if these properties are occasionally personally used. And so this is also another whole bag of tricks and really determining how much has been used personally. Is this, and what is there a profit motive is what it really all comes down to. Are you expecting to make money? Is it a business? If it all seems like this is your personal house and you rent it to your friend for a week, this is not a business.
Okay. Any other questions from the library?
All right, thank you, Carolyn and Heidi. Appreciate the time. For everybody here and online, we'll share contact information both ways for everybody. So if you have any further questions.
And remember to say where you heard about us.
Yes. We'll make sure that contact information goes both ways. Looking forward to seeing everybody at 4 o'clock at Anina in Hayes Valley. Thank you.
Thank you.